Well, howdy there, folks. In this sort of market, there are a lot of lies being told in this sort of market right now. We're in an ultra volatile market. You've got earnings going on. You've got stocks moving up crazy amounts, moving down crazy amounts. All this going on. People are scared. People are like, oh my gosh, is my stock about to go down 20, 30%? All these sorts of things. And I want to just kind of get through all these lies in one video because I see so much that is said out there. And I'm like, that's not even accurate information. And the great thing about the stock market is you can look back at data and basically decipher whether things are lies or whether they're truths, essentially. And so I want to kind of share my perspective as somebody that's been doing this for a really long time and kind of show you the data behind it. Okay, I hope you enjoy this video. I hope you get a lot of value out of it today. I think it's a really, really important video. First thing you're going to hear out there that I don't know how this gets out there, but the Fed. Everybody talks about the Fed, right? And so people assume, or people are told, that essentially if the Fed raises rates, that means the stock market's going to be a disaster zone. We're going to head down. It's going to be a bad stock market. And if you look back just at data throughout time, you find that is the furthest thing from the truth, okay? So 1971 through 1974, essentially, the S&P 500 did go down. Outside of that period, and that's when rates went from 3.75% to 13%, outside of that, you're going to find that every single time period, the stock market actually went up and did very, very well, okay? 1976 through 1981. Look at this. The Fed funds rate went from 5.5%, which we can't even imagine a 5.5% Fed funds rate. It went from 5.5% to 20%. 20%. Could you imagine a 20%? If you told people we're going to have a 20% rate, like everybody out there would say the stock market's going to crash like 50%, right? But look at what happened here, right? Fed funds rate goes from 5.5 to 20, and the S&P 500 over that time goes up 68%. And given that's not even in the computer age, that wasn't even in this ultra age of productivity and artificial intelligence and all the crazy advantages we have nowadays, right? That's extraordinary that the Fed funds rate went to 20%, and the market did not only good, it did amazing during that time period, right? 68% return. That's a no joke as holy smokers right there, okay? Now, 1983 to 1984, we went from 9.5% to 11.5%. And what happened to the S&P 500 during that year? We went up 8%. 1985 through 1988 went from 6% Fed funds rate to 9.75%. Remember, these rates are crazy high. Like we can't even fathom these type of rates, right? And what did the S&P 500 do during that time when the Fed was raising rates? Went up 52.42%. That's extraordinary. And once again, this is totally before like the computer age and all the things companies have that are super advantages now through looking at their data for their businesses and all the outsourcing and basically global manufacturing. All these things weren't even a big thing back then. And still we had an extraordinary market every single time the Fed raised rates. 1994 to 1995, what happened? We went from 3.25% to 6%. And the S&P 500 during that year went up 4.4%. 1999 to 2000 went from 5% to 6.5%. S&P 500 went up 10.48% during that year. We're seeing a trend. If we look at 2004 through 2006, went from 1.25% to 5.25%. That's a big raise there, okay? S&P 500 during those 2 years went up 17.7%. And then 2015, the most recent one, 2015 through 2018, we went from 0% to 2.5%. And the S&P 500 during that time went up 28%. And that was despite during that time the tariff situation, which was huge news in the stock market during that time. Everybody's talking about tariffs and how companies' profitability was being hurt during this time because of the tariffs and all this stuff, right? All that drama was going on. And yet the S&P 500 still found a way to return over 28% during that time, right? So what you can learn from this is, in fact, if the Fed raises rates, that does not mean the stock market's done. Doesn't mean we're ruined. Doesn't mean all our stocks are going down, 50% from here. Doesn't mean that at all. Actually, what it does mean is we're actually more than likely going to have a really good stock market if the Fed raises rates. And that's just going on literally the facts and the data from the past, okay? If we go ahead, and I want to give this gentleman credit for this, downtown Josh Brown, okay? Let's take a moment to break down the hysteria. Okay, the average total return for stocks during a rate hike cycle, positive 23%. A big caveat that you're not seeing is a volatility on the way to those returns that's on the table, right? For example, 1973 through 1974 was rough. You had the Vietnam War, you had Watergate, you had the Arab oil embargo, you had inflation, and stocks fell 50% before recovering. Stocks historically hedge inflation better than any other asset class by outdistancing it over time. But there's a price you have to pay for this work, and that is volatility. And that's essentially exactly what we're seeing right now in this market. So much volatility in this market. It's insane, right? You're seeing literally, I covered this last week. I told you guys, we're seeing, the mega cap stocks, large cap stocks, the biggest of the big companies trading like penny stocks, where some of these stocks are moving down and up 20+%. And these are companies with hundreds of billions of dollars of market capitalization. Like, I mean, if this was crypto, even people would be like, this is crazy, okay? Never mind the biggest of the big companies. And so the price you have to pay during this time is this ultra volatility that freaks a lot of people out. And what ends up happening is a lot of people get scared, right? A lot of people end up making very poor short-term decisions around their money, and they sell out of stocks, and they let other bigger investors who have the right mentality and understand. Here's the thing, right? Imagine for a moment, and then I got a lot of other cool stuff to show you guys in this video, okay? Imagine for this example. You got a stock here, okay? This stock is $10 a share, let's say, for instance, right now. Now, everybody understands, based upon where this net income for this company is going over time and what valuation they should be able to command, that this company is likely going to become a $50 stock, right? So you got the stock at 10, it's likely going to 50 over the next 5 years. So if this stock reports bad earnings, good earnings, whatever the Wall Street wants to look at, whether that stock goes down to 8, whether it goes down to 9, whether it stays at 10, whether it goes up to 11, 12, 13, 14, down to 6, it doesn't matter. In the end, it's all just a huge buying opportunity because the stock's likely going to 50 over the coming years, right? And so the finesse of Wall Street, right, and the beauty behind the madness, I guess you could say, is that the people that get scared in these sorts of markets, they sell out of these great assets for prices that are usually disgustingly low because they're scared, because they're getting shaken around with all this volatility, right? Even though they don't have to sell out, they don't have to sell out, but they're in this situation where they feel they have to sell out because it's so scary. And so they sell out. The big funds come in, buy up those stocks, the hedge funds, all the big money. They come in, load up on those shares, and then everything likely ends up working out for that company. Next thing you know, it's a $40, $50, $60, $70 stock in the coming years. And the smaller money's over there looking like, oh yeah, I remember when I used to hold that stock, but it was scary because I held it in this year, and there was ... going on, and the Fed was going to raise rates. And it's like, the Fed was going to raise rates, and you sold out of a company that's got a great business model for the next 5-10 years in front of themselves, and growth through the roof for the next 5-10 years, and you sold out because the Fed might raise rates? Like, what are you doing here? Yeah, the Fed raises rates. That's usually a very, very bullish thing for stocks. So, but this is what happens in the market, and it's unfortunate because it happens over and over and over again, and this isn't the last time it will happen, and it won't be the last time it happens. It'll just continue to go on, right? This is a great post B-Man sent me, essentially. I love this one, okay? Days, decades, the simplest post you ever saw right there, but I'm like, it's the truth. It's the truth. In this market, you're up, you're down, you're all around, right? And a lot of us have been hit very heavily the past several months, and, it's been painful. There's been a lot more downs and ups, right? But over time, this is the trajectory. All of this volatility will go away. Next thing you know, it'll be smooth sailing, and we're going to have some crazy upward moves, and everything kind of plays out, right? And the great companies that have unbelievable business models that are going to grow revenues 10% plus per year, year after year after year after year, their stock prices will thrive, and there'll be a ton of money to be made, right? Now, look at this. So this shows you the Russell Growth Index, essentially January performances. Obviously, recently it was the worst one we've ever had. So it was rough, but a lot of folks assume, well, okay, Russell and all the markets were down, significantly in January. Well, that means it's going to be a horrible year. Not at all. There's as many times that you'll see we'll have a bad January and actually end up having a great year, and the market actually ends up trending up quite well. And so I never get too caught up into this whole making a judgment based upon, January was a disaster. That means this whole year is done. We're done. And actually, if you listen to what a lot of folks say, even Tom Lee and some others, they said you're going to have ultra volatility. I try not to make, short-term market predictions myself because, that's just not my thing. But in terms of the people that do like to stick their head out there and try to make those predictions, almost all of them, even the people that are very bullish on the market, said we're going to have tremendous volatility in the first half of this year. You're going to have some massive moves up, some massive move downs. And that's exactly how we started out this year. The worst January ever. But that doesn't mean the whole year is done, essentially. It doesn't mean like, oh man, the Russell's done for this year, the S&P 500 is done for this year, NASDAQ, because you're going to find many of these years, the markets actually ended up trending back and recovering very, very nicely as the year went throughout. And by the end of the year, many of those years, you ended up actually coming out with a gain. And some of those years, you ended up coming out with 10% plus gains. And that's just for the overall markets. Remember, some stocks in there are going to be up 30, 40, 50, 60, 100% plus, right? So yeah, don't get caught up into, it started out so bad, so it's going to be the whole bad year. It doesn't mean that at all, okay? It's just another thing that, folks like to try to, say, and it's completely false, right? Now, you have obviously earnings season going on right now, and we're about to get into small cap season, really. This week starts kind of the small caps, and then we kind of got that going for like the next 3 weeks, maybe 4 weeks, essentially. Small caps, I know a lot of my small caps are all reporting. Corsair Gaming is one of the first to report, okay? And essentially what you have happen here is everybody starts to look, right? And they see all this volatility in the market, and they start to make decisions around buying or selling, not really buying stocks, but selling out of stocks that they really like for the long term because they're about to report earnings. And they're thinking, oh man, I should probably sell out this stock because it could go down 20%, could go down 30%, right? Could go down 15%, 10%. And, I don't know if I want to go down like that. Maybe I'll just buy back. And so they put themselves in this mindset where they start making all these short-term decisions. And that's just not the way to invest at all. And the sad thing is, people are doing this with companies that they ultra believe in for the long term. They're just scared and they're like, maybe I'll be able to buy it back for 20% cheaper the next day after they report because look at all these stocks that have fallen, right? Rather than look at it from the perspective of, it could also go up as well, right? Why do I need to make a short-term decision to sell out of a stock when it could easily just as much go up as they could go down, right? And you saw this with the Amazon earnings. Perfect example. Amazon's obviously a great company. We all know that, right? There's nothing you can really say bad about Amazon. I mean, I know their growth is not going to be what they had expected it to be this year, at least in 22. But outside of that, like Amazon's a beast. Like it's a fun, the company has so many different businesses. It's an incredible company, right? But you had people selling out of the stock in mass the day before earnings because they looked at the Facebook earnings and Meta. I don't know why I still call it Facebook. Meta fell 25% on their earnings, and so Amazon shareholders, right? They got scared and they're like, oh my gosh, look what happened to PayPal. Look what just happened to Meta. Maybe we're about to go down. And what did they do? They went to the floodgates and they sold that stock and they sold that stock and they sold that stock and ended up moving down like 7% the day before earnings, which is extraordinary because Amazon's a $1.5 trillion company or so. So you know how many people need to go out and sell and put selling pressure on that the day before earnings to get that stock price to go down the way it did? And here it is, right? Amazon's a great long-term company, and people are trying to time this out and trying to be like, well, it might go down 20%, 25%, so let me get out. I'll get back in after earnings, and it's just the silliest thing. And guess what ended up happening, obviously, to Amazon? Well, stock went up, and it had a great next day. And so then people are, next thing you sold out at, $2,700 something, and now you got to buy back at $3,100, $3,200, $400, $500 a share more expensive than essentially where you sold out at. And it's like, for what? For what? Because it could go down. It could easily go up as well. And keep in mind, the more battered stocks are, the higher probability that if they just report decent numbers, something positive in there, their stock prices are going to fly up. Amazon's stock price was higher in the summer of 2020 than it is today. It was $3,450 back in July of 2020. And so going into these earnings at 2,700, it was really low. And I even had serious thoughts. I was going to throw $100K just into Amazon. I didn't do it because I looked at it from a perspective of, I was like, that would be even me making a short-term decision, right? I love Amazon for the long term, but I was looking at it from a perspective of this stock's so beaten down, it's 27 to 100 something, high probability something will be seen as a positive in there and the stock will go up. Obviously, hindsight's perfect and I wish I would have done it, but that would have been me making a short-term decision, right? And I'm like, nah, don't go there, Jeremy. We've done that earnings trade crap before. Let's not go down that route. But I have serious thoughts about that, right? And so this is where you start to get everybody in this sort of market that's ultra volatile, right? Start to make these short-term decisions. These just aren't decisions that would usually be made. But when the market gets ultra volatile, people make that. And it's sad because look at how many people sold off that stock the day prior to earnings. For what? For what, man? To hopefully it goes down to 2,400? Sure, it could happen. It just gets, when these stocks get more and more beaten down, it gets more and more unrealistic. Stock hasn't moved in a year and a half. To get it down to 2,400 would have been a beautiful thing, but it's pretty darn unrealistic, right? It's like you start getting very, very greedy in the market. And that's the thing that happens, right? People start getting really, really greedy in the stock market. Stocks, continue to go down and down and down, and it can't get low enough. People are like, oh, it's going to go even lower and I'll buy it then. And it's like, you realize how greedy you're getting by hoping these stock prices continue to go down more and more and more. Same thing happens on the upside, right? When stocks are going up and up and up, people are like, a 1% drop in a stock. People are like, buy, got to get in. And it's just, it's silly in the end, right? I posted this in the Discord chat because there's another lie that's obviously told out there. Like, the market's been so amazing. It's been so amazing. And so I pulled up the Russell and I was like, I feel like the Russell hasn't really done much. And I feel like the some of the other indexes have definitely outperformed the Russell. So, and I posted this. I look back at the past 5 years. The Russell's up 44% in the past 5 years. And you think about the flood of money out there. You think about how much progress has been made from companies, in the markets in general, right? In terms of the Russell. And a 44% gain in a 5-year period is not good. Not good, especially for a time period where the flood of money was out there and you had a lot of companies making great progress with their businesses. And we're obviously living in a time period of, really ultra profitability for companies out there in the way they figure out how to run their businesses more profitably than we've ever seen, right? And so this is not great performance in the end, right? And this is another thing that's kind of told out there. And it's like, you really look at the data and you're like 44% in 5 years, that's okay, but not great when you've had this flood of money out there. So, and if you look at the valuations, I go over this all the time, the forward P metrics and things like that, for small cap stocks, we're trading at unsustainably low prices essentially, and that cannot last for very long. I looked at the S&P 600 small caps. That's not sustainable. How low we're trading. Even mid caps are trading so unsustainably low. The market can only stay in those unsustainable levels for so long, and then it has to come back. And so what ends up happening in this sort of market is the smaller investors have their shares essentially almost stolen from them because they end up making really bad decisions around short-term selling. And meanwhile, long-term investors who understand this game, they buy up those shares at significant discounts, and those companies, their growth stories are likely going to play out. And meanwhile, the people that didn't really know what they're doing, they just had their shares essentially stolen from them. And it's unfortunate. And it happened. I've seen it happen before. It's going to happen again. It's happened to me when I was in my first few years of investing. And, it's unfortunate in the end. And so the moral of the story is don't make short-term decisions to sell out of stocks based upon it could go down, because it could easily just as go up. And at the end of the day, if you're really truly a long-term investor who's planning on holding that stock for the next 3, 5, 7 years, you've got to be willing to hold through the earnings. And if you get a big dip, cool, buy the dip, right? And if you don't, then great, you prosper. But there's no worse feeling to me personally than trying to sell out of a stock because it might go down, then that stock goes up and you're on the sideline. That to me is the worst feeling. I would much rather be in a stock and it goes down 20% than me sell out of a stock and then it goes up 20%. I'm on the sideline looking at it and I'm like, yeah, I sold out of that and now it's up 20%. Great job, Jeremy, okay? There's no worse feeling than that, in my personal opinion, okay? We got a massive Valentine's deal sale coming up for the Private Stock Group Financial Fortunes Program. If this is a time period when you want to take stock market investing serious, which it should be, make sure you check out pinned comment down there, sign up for the wait list so we can send you that deal as soon as it comes out. It's a pretty big deal. Make sure you subscribe to the channel. Much love as always. Keep your head out there and have a great day.